The Federal Reserve meets this week, and markets around the world are watching every word. The Fed's policy meeting, and the statement and press conference that follow, ranks among the most closely watched events on the financial calendar each year. That is not an exaggeration. When the Fed speaks, borrowing costs move, currencies shift, and asset prices reprice from New York to Nairobi. At the center of it all is one number: the federal funds rate. That is the benchmark interest rate the Fed controls, and it sets the floor for borrowing costs across the US economy. Mortgages, business loans, credit cards, they all take their cue from it. And because the dollar is the world's reserve currency, the Fed's decisions do not stop at the US border. Here is the basic mechanic. When US rates are high, investors tend to move money into dollar-denominated assets: treasuries, dollar deposits, US equities. That demand pushes the dollar higher. A stronger dollar, in turn, puts pressure on other currencies and makes it more expensive for countries that borrowed in dollars to service their debt. Emerging markets feel that squeeze the most. So far this year, the Fed has held rates steady. It is waiting for clearer evidence that inflation is on a sustained path back to its 2% target. Growth has held up. The labor market has stayed firm. Those are two reasons the Fed can afford to keep rates where they are without triggering an immediate downturn, but they are also two reasons it is in no rush to cut. Markets have been adjusting their expectations repeatedly this year. Each new jobs report or inflation reading has sent traders scrambling to reprice when the first rate cut might arrive. Those shifts have moved bond yields, equity valuations, and exchange rates in quick succession. A clear signal of just how tightly global markets are wired to Fed decisions. This week, the focus will be on tone. The Fed rarely moves rates without telegraphing it first. So even a small change in wording, a phrase added here, a qualifier dropped there, can carry real market weight. Investors will be listening closely for what policymakers say about the balance of risks. Is inflation still the bigger threat, or is slowing growth starting to earn more attention? The statement and press conference are the key events to track. The signal embedded in the language will shape expectations for the months ahead, and those expectations will flow directly into bond markets, stock prices, and currencies well beyond US shores. Pay attention to what the Fed does not say as much as what it does. In central banking, silence and omission are often the loudest signals of all. This briefing is brought to you by First Financial News. Clear, daily coverage of the economy and markets at firstfinancialnews.com.